Hi, Mark Sorenson, CEO and Chief Investment Officer at Royal Fund Management. We're going to do a market commentary video today that we hope is helpful. The last one we did was February 6th, and quite a bit has happened since then. Let me go ahead and share my screen. I'm going to show you a chart of the S&P 500 over the last year, and we'll provide some commentary. This is a chart of the S&P 500 going back a year. And as you can see in the upper right, we're in a little bit of a backing and filling, profit taking, corrective action, if you will, which is normal. The market did so well since about November 1st last year. It's actually healthy to come back down a little bit and build a better foundation for the next move up. We kind of expect that the market has entered into a phase kind of like 2021, where we had many times the market pull back about 5%, 5 to 7%, but then didn't last long. The market would recover pretty quickly, and we think we're back into a pattern like that time frame. So, for example, if you look on the chart here, you'll see that 3 month correction where we went down a little over 10% over 3 months after a great 2023. We got into a little trouble in late July, and we went down for a total of about 3 months, or roughly 10%. But then you can see what happened from there with just a strong move up that lasted all the way through the end of March this year. As the calendar turned to April, we started to get into a little bit of a corrective action. You'll see the red trend line that I drew on the chart, which is a series of about 6 months, a series of higher highs and higher lows as the market just kind of stair stepped higher over time. That trend line was finally broken, and then we finally broke what's called the 50-day moving average, which is just an average of where the market has been over the 50-day period. And that caused a little bit of a technical breakdown. However, as we said earlier, we think this is going to be kind of like 2021, where we have little corrections that do not last very long, do not go that deep. They're pretty shallow. In fact, we don't even think this will be like the 3 month correction we had in 2023. But a few things to talk about that may have caused the recent corrective action and the need to come down a little bit and take a little bit out of the froth off the market. Obviously, the Fed through most of last year was raising interest rates. They finally started to turn a little dovish, even the talk of lowering interest rates at some point in time this year. But what's happened recently is we went from an expectation of as many as 6 interest rate cuts this year to as few as 3, to as few as 2, maybe only 1. And now there are people predicting that we will not get a rate cut at all this year. Most people predict we will see rates cut, but it's been pushed out on the calendar a little bit. Why is this happening? Well, we have tamed inflation to a great degree. Inflation measured by the CPI was over 9% nearly a year and a half ago, June of 2022. Now we're looking at 3.5%, 4%. So interest rates inflation has come way down. However, the last 2 or 3 consumer price index reports have shown that's a little bit sticky. It's kind of like the last mile, they say, takes a little longer. Well, the Fed wants to get to 2%, but from getting from 9 to 3 was pretty easy. Getting from 3 to 2 is going to take a little bit longer. The Fed Chairman Powell is still relatively dovish in his comments. There's an FOMC meeting, Federal Open Market Committee meeting going on right now, where they'll announce their decision tomorrow. We do not expect any rate decision tomorrow. Whether rates go up or down is not the question. The question is the commentary, and whether, because of sticky inflation of late, they have to become a little bit hawkish in their talking points. That may happen. That might cause the market to come off a little bit more. However, earnings are doing extremely well. In 2022 into 2023, we went through a little bit of a corporate earnings recession, but earnings are starting to grow again. In fact, the S&P 500 companies that have reported so far this quarter, 77% of them have beat on the bottom line, meaning earnings per share. 60% have actually beat on sales or revenue expectations. With that happening, earnings have kind of come to the rescue. In fact, even though we've had some corrective action here the last 30 days or so, last week was the best week the market had had since last November. In fact, if you look at the pattern that's starting to develop in the far right hand side of the chart, I recognize on a tablet or a telephone, this chart's a little bit hard to see. Apologize for that, but if you have the opportunity to listen to the recording or watch the recording on a desktop or a larger screen, it should be more clear to you. But I'll walk you through it. Since the lows a few days ago, we've started to redevelop a period of higher highs and higher lows. In other words, that stair step pattern that might lead to recovery. We still have a lot of earnings to come, though. In fact, even tonight, we have some big earnings from companies like Advanced Micro Devices, for example, in the semiconductor sector. The problem is that we've had very good economic reports. Well, it begs the question, would we rather interest rates go down because the economy is weakening, or would we rather have a good economy? Well, most people would still rather have a good economy. But the problem is we've got a little bit of a tug of war going on right now between the bulls and the bears, if you will. The economy is still growing, but slowly, but inflation has gotten a little bit sticky. Interest rates have gone back up a little bit because of the concern about when will inflation start to trend down again, likely over the next a couple months. We've come down from the intraday high to the intraday low so far in this correction. We've come down about 5.9%. That's kind of what we expected, a little 5 to 7% pullback, relatively shallow, relatively short-lived, meaning that the recovery, we think, as earnings continue to come in good, the recovery will come relatively soon. And we think the market still is likely to do better as earnings are starting to recover and growth is coming back the balance of the year. We do think that part of that market strength the balance of the year will be helped by lower interest rates. But now, where the first cuts were expected potentially in May, now the odds are about 50-50 that we'll get our first cut in September. But we do think interest rates will come down. Inflation will head the right way. Earnings are recovering. So we do think that over time, the market's going to continue to do well as growth has come back to the economy. And the market's doing generally pretty well overall. The economy. Some people say that they just don't see it. The GDP, the gross domestic product, the economic indicators indicate that the economy is doing pretty well, but a lot of people say they just don't feel that, and to some degree that's true. The consumer is holding up very well, but it's kind of the top 40% of income earners that are driving most of the consumer behavior. And it's very unfortunate that the lower 20% of earners are the ones that are really feeling the pressure from inflation. So we hope the Fed can get it under control and yet do that at the same time that the economy can continue to grow, and that helps all of us. But from a pure market perspective, earnings are good. Interest rates will come down at some point in time. We still think inflation, though sticky, is headed in the right direction, and we expect the market to do well for the second year in a row. Sometimes buying begets buying, and after a horrible 2022, we recovered in 2023, and now the second year into the recovery, we expect the market to still continue to do well as earnings growth continues. With that, I hope everybody has a wonderful spring and summer, and we'll talk to you again soon. Thank you.